Morning. Thank you, Richard. As he says, we'll give a brief introduction around the markets, what's happened over the last year. So a quick recap, what's changed, what's happened. We're also going to look, Richard has a fairly famous question now, where would you have spent $500 million if you could do? So we're going to look at the returns that you would have got by investing 5 years ago across the region and comparing that with some IPD results for like Germany, Spain and Holland. How would CEE have done? And then we'll touch on the factors that are going to drive conditions further ahead, macroeconomic, country market summary. Is there still value in values, looking at where capital values are today relative to their historic average and peak. And then we'll just touch on some of the other major structural changes that are going to be impacting markets going forwards. So just as a quick summary, hopefully you can just about read this, I'll go through it very quickly. This is roughly what we said last year. Long-term good investment potential. The region produces 20% of GDP, only 10% of investment volumes, 35% of stock, 50% of the population. Short to mid-term, capital values are certainly below par and often below peak, so there's upside there. And from a yield perspective and a risk-adjusted perspective, it was pretty positive relative to the likes of Germany. Bank finance conditions were starting to improve, but they weren't actually distributed across the whole market, which was a bit of a block on trade. That's a reflection of a lack of local capital market depth generally. But with strong international investment and this increasing wall of money looking at real estate, that isn't a problem, certainly short term. There's some perception of certain markets being worse than they were. There were concerns as to some of the office market conditions with regards to vacancy and rents, but they're now stabilised. It's looking more positive going forwards. Industrial logistics, strong growth capacity, and we'll see that showing through in the investment volumes. Some pockets of retail yet to be untapped, but it was looking relatively saturated. But the likes of high street retail, city centre retail, yet to be fully developed in a lot of markets. So there's a lot of opportunity and a lot of positives. Russia-Ukraine situation has certainly changed things. So we'll look at to what extent it has changed things. And equally, outside of the CEE region, at the beginning of this year, economic forecasts were looking very positive for the Eurozone as a whole. As of today, we've got a fairly sort of fragmented Eurozone. Growth is looking pretty patchy by different countries, which should actually play into the hands of CEE, given that GDP is an important proxy for driving occupier demand and investment demand. So the green line represents the change in investment volumes up to 2013. So volumes did go up last year, getting above 2012. At the beginning of the year, we then said, okay, there's going to be 3 scenarios potentially that pan out. One is a pretty aggressive best case scenario, so an increase in volumes across the entire region. Mid case was a slightly more moderate prognosis for, okay, investment volumes will increase, but maybe not at such an aggressive pace, driven by a lack of product primarily, or what's going to happen in Russia-Ukraine is going to actually put a freeze on certain transactions happening across the market. So what's happened, we've actually seen the worst case scenario filter through. So Russian volumes are down. By mid-year it was about 750 million compared to about 2 billion last year, and that's put a hole in the overall total in the market. But it's not the whole story, because there are increasing levels of investment volumes happening outside of Russia into the tier 2 markets in Eastern Europe. So if we look at the split of where investment has gone, pre-2009, it was pretty balanced. Poland leading the way, Russia, Czech, Hungary accounting for a fair split. Romania, a decent amount after that. Pretty different market from 2009 to 2013. Russia dominating alongside Poland. Czech Republic just coming after it. But there's small amounts happening in the other sort of more tier 2 markets. But so far in H1, Poland is now significantly ahead. Russia is still there. Investment volumes haven't stopped entirely. But Czech Republic is growing as a market, and there's also growth in volumes in the Baltics, in Hungary, and Romania, and all the tier 2 markets. They're all looking like we'll do much better than last year. So, yeah, volumes in Russia are down, but it's quite isolated. It's only in Russia that it's impacted so far. Everywhere else is starting to see increasing levels of volumes. Poland should at least match last year. Czech Republic will most probably beat last year by a significant margin. If we look at some other trends in terms of which sectors the money has gone into, As per usual, it's typically office and retail, though again in the last year, we've seen a bit, or the last 2 years essentially, a bit more transactions happening within the industrial sector in particular. Now industrial is becoming hot property across Europe, and it's certainly becoming hot property within the core CE4 of Eastern Europe, driven by distribution growth coming into the market. And it's starting to take some market share. I mean, some more hotel deals, other deals as well, but we don't have residential as an institutional investment class in Central and Eastern Europe yet. So that's going to be something that we'll be watching going forwards. But today it's about 0.1% of the market compared to about 10% for Europe generally. But it is typically offices and retail that continue to dominate, but industrial is featuring more and more. And what this one shows is the rotation of industrial stock relative to the size of that sector in square meters. So the pale blue line represents industrial. So as a proportion of the volume of space out there, we're seeing more and more of that stock being sold. Office is also growing. Retail is pretty flat. Now retail is a very defensive asset, certainly the larger shopping centres, and holding terms are continually increasing because they're bought by buyers with a long-term hold strategy. And generally, sort of regional liquidity, which is the yellow line, is only just starting to creep up again. So even though volumes are increasing, we're nowhere near the days of 2007 in terms of how much stock is being bought and sold, which still suggests that there is more room for growth for increasing levels of volumes within the market. The yellow dot represents total returns. So we've tracked the markets across the main CE markets in industrial, retail and office to look at what returns you could have got by tracking the market within each country. So generally, the pale blue or the yellow dot is total returns, pale blue is the income return, dark blue is the capital gain. So it's the changing capital values. So offices generally, you would have got a pretty balanced return. And if you diversified into CE, you'd be getting close to 8%. In industrial, you've got a bit more divergence in terms of the returns you would have got. But again, in CE industrial, you would have got about 5%. Retail, you would have done best. You would have got closer to 10% overall, or 9%. Obviously, there's pretty big differences between markets. So, industrial, you would have wanted to get into Slovakia and Czech Republic. In Poland, you would have wanted to get into offices and retail in particular. In Slovakia and Bulgaria, which are very saturated retail markets, it would have been more difficult to get any kind of positive return. If you look at it by country, again, Poland you would have done best, followed by the Czech Republic, Romania, Slovakia, Hungary, Bulgaria. Risk-adjusted returns relative to government bonds in that market, Czech would have come out just on top. But again, a CE portfolio would have stood you about 7% if you'd gone across all of those markets on a weighted basis. But if we look at it relative to Germany, Holland, Spain, offices in CE, you would have beaten the IPD return for the last 5 years. Same with traditional retail. Industrial, it would have been around about par. And income returns in industrial would have been about the same as Germany and Holland. Now, Germany and Holland are major logistics markets. So it's actually quite impressive that CE's managed to stay at that level and beat the other two sectors. So despite the perception of investing or diversing across the region or getting into certain markets, you would have done actually pretty well if you bought 5 years ago. And that's in markets that have had pretty soft rents and to some extent rising vacancy. Now rents have stabilized in the last 2 years. There's only maybe 2 markets that rents are going negative. So things are looking more positive going forwards as well. Now, the other factor to consider looking forward is to what extent has the Russia-Ukraine situation altered GDP forecasts. These are the forecasts in January. These are the forecasts from this month. So these are consensus forecasts given by a bunch of experts that we filter through to get essentially what they're saying looking forwards for the next year. So the markets that have seen forecasts come back is obviously Ukraine quite significantly, also Russia and also the Baltics. But actually for the other markets, apart from Croatia, which has structural issues, let's say it has to go through a lot of structural reform to try to get growth back into that market, all the other markets look more positive. than they were at the beginning of the year. So there's quite a distinct difference across the region in terms of what's happening on the GDP growth side, on the economic growth side. I think we're only just starting to see the start of it in terms of what impact sanctions will make. So in the likes of the Baltics, it's impacting dairy farmers, but it's not yet really impacting the real estate market. I think Polish GDP is being pared back a little bit as a result of Apple sales. That's my joke for the day, players Apple. But generally, things are pretty positive. In terms of values, so we look at long-term average values and peak values and where markets are now and in relation to those. So 0% would mean you're at that level. If you're above the 0% line, you've got above that market. So dark blue is average, pale blue is peak. So on the office side, there's a few markets that have got back to peak values, which is the Russian and the Baltic markets, but everywhere else is below peak. Some markets are now just about on their long-term average, but there's still, there doesn't seem to be huge inflated prices relative to the historic trend for offices. Similar situation in industrial. Again, it's the Russian and the Baltic markets that are looking a little more inflated. Like, you have to bear in mind that their time series is actually a little bit shorter than the other markets, so the average will be a little bit higher. But still, across, outside of those markets, there's still value growth in Czech Republic and Poland and all the other markets. Retail is a little different. A lot of markets are now back to where peak values were, apart from Southeastern Europe in particular, and some have actually gone quite a bit ahead of their average. So retail has probably got less capital value growth relative to historic trends going forward. This is what we would have said conditions were like last year. So dark green is very good, and this is from an investments perspective. Orange is poor, and this looks at the political regime, it looks at economic forecasts going forward, it looks at property market conditions for retail, industrial and office, and it also looks at the availability of finance and the amount of investment trading that's happening in the market. And then we go through each market, each major city within each market, and say, okay, what's the actual overall condition? So if you looked at retail specifically or industrial specifically, you may get a different colour. But generally, Poland looked very good, Russian looked very good, Czech Republic, Slovakia, pretty good. Yellow is quite neutral. Grey represents markets that we didn't actually cover in so much detail at the time. Now, Russia doesn't look quite as good as it did a year ago. That may need to go a little bit paler again. So the Baltics are looking pretty strong. Czech Republic is now coming back. Politically, it's sorted out a lot of its problems and it's got more stability. And some of the other markets, the tier 2 markets, are also coming back. So Hungary's got a lot better, but it's still maybe neutral on balance given the autocratic political situation, let's say. But investment volumes are certainly increasing in that market. And generally things look a little bit better. Maybe as of the end of Q3, some of these other markets need to be paler, but there's quite a bit of divergence across the region, but most markets are moving in a positive way rather than moving the other way.